So how does an insurance company pay you to take their money? Hello, this is Scott Schwartz from nevertoomuchmoney.com. I've reverse engineered the way banks and the wealthy use their money so I can help my clients become their own virtual banker. So the answer to that question is one word, and that's arbitrage. How does an insurance company pay you to take their money, to borrow money from them? Well, let's consider just what that word arbitrage means. Arbitrage is that you pay and you get paid during the same transaction. So now it's not to be confused with an investment where you have time in between. The key to arbitrage is that it's simultaneous. You pay $100 to buy a stock, and then in a year you sell it for $120. That's not arbitrage. That's a risk that paid off, turned out to be a good investment. During that time, you bore the risk that the market might go the other direction. And you also realize that in that time, inflation would dilute the value of the investment gain that you made. But arbitrage is truly simultaneous. You pay and get paid at the same time, the same transaction. We've been talking lately about the policy loans in the infinite banking approach and how that works. And really a key behind it is the fact that you get positive arbitrage. Let's take a quick look at the numbers without getting lost for all of you who aren't numbers people. But typical numbers today are in the ballpark of you receive a guaranteed rate on your cash value of 4%, but the loan amount that you owe to the insurance company for borrowing their money is about 4.5%. The typical spread or difference is around half to 1%. There's been times where it's been a wash loan, where it's actually a 0% loan. So it seems like in this scenario, you're guaranteed to receive 4%, but you're paying 4.5%, that you've got a loss, a small loss, but yet still a loss of 0.5%. But remember, there are dividends that you can receive. Dividends are not guaranteed, but they've paid consistently every year for over 100 years with the major mutual life insurance companies. Now let's take an example of one of the larger players in this game, MassMutual. I choose them because they released a report that shows their dividend rates going back to 1978, so 43 years. In that time, the lowest dividend rate was 6.8%. Now, full disclosure, that's the gross rate. There's really no calculation needing to be done there, though, because that's the full amount that you earn. We don't add that 4% on top of it. The 4% is included in it, in other words, in simple terms. So the gain there is 6.8%, and that's in the worst year of the last 43 years. And we're paying how much to get that 6.8%? 4.5%. So right there, in the worst year, we're getting a 2.3% positive arbitrage as we borrow that money and pay back the interest. As we considered yesterday, that's key. So think about that. That is just the act of borrowing the money and paying it back. Keep in mind that we're using that money for a purpose. We're using it to buy our own debt, such as a credit card where we're paying around 20% interest against us, or we're turning around and investing it, buying real estate, buying crypto, buying whatever it is that you choose to invest in. We, in the worst year of the last 43 years, are already making a gain before we even start to invest that money. Why? Thanks to arbitrage and how safe that transaction is with the major mutual insurance companies. So there's a key reason why I keep saying how this really turbocharges your investment portfolio, because we're using a base that is going to grow on the whole amount, even though we borrow money out of it to pay off debt, to invest. The act of borrowing it and paying it back with that interest is really nothing to fear because we have positive arbitrage already in there before we even put that money to work. So I hope you enjoyed that. I'm Scott Schwartz, nevertoomuchmoney.com. Thank you for tuning in.